Hey everyone, welcome back to Research Investment. I'm Simo, your equity research analyst host. Today, I want to talk about something that, in my extensive view, most investors completely overlook or simply don't dig into enough. Yet, it's a foundational force that shapes everything from individual stock prices to broad commodity trends. If you're missing this crucial indicator, you're quite frankly leaving a lot of money on the table in the stock market. I'm referring to the US dollar index, or what we commonly call the DXY. This isn't just another number, it's a metric I personally track day after day in my own analysis. And for all serious stock market investors, understanding this indicator is like uncovering a hidden treasure. The DXY isn't merely a figure, it's a powerful barometer of global economic sentiment and, critically, a primary driver of market movements. Let's really dive deep into what the DXY is, why it holds such immense importance, and most importantly, how you can leverage its insights to inform your investment decisions. First off, let's break down what the DXY actually represents. The US dollar index is essentially a weighted average of the US dollar's value relative to a select basket of 6 major world currencies. Think of it in practical terms as the dollar's report card against its most significant global peers. This basket is heavily weighted, with the euro making up a substantial 57.6%, followed by the Japanese yen at 13.6%, the pound sterling at 11.9%, the Canadian dollar at 9.1%, the Swedish krona at 4.2%, and the Swiss franc at 3.6%. The DXY was established back in 1973, following the collapse of the Bretton Woods Agreement, when global finance shifted from fixed to floating exchange rates. Its base value was set at 100. So, if we see the DXY trading at, say, 104, that indicates the dollar has appreciated 4% against this specific basket since its inception. Conversely, a reading of 96 means it has depreciated 4%. It's a straightforward but incredibly powerful way to gauge the dollar's overall strength. Now, from an analyst's perspective, why is this so incredibly important for you, the investor? What we're seeing consistently is that the DXY's movements have profound and far-reaching implications across virtually every asset class you can imagine. Let's start with its impact on US equities. When the dollar is strong, meaning the DXY is on an upward trend, US exports naturally become more expensive for foreign buyers, while imports become cheaper for American consumers. This scenario can significantly compress the earnings of large US multinational corporations that derive a substantial portion of their revenue from overseas. Those foreign earnings, once converted back to a stronger dollar, simply won't be worth as much. On the flip side, a weak dollar makes US exports much more competitive globally and conversely makes imports more expensive. This dynamic generally boosts the earnings of those same multinationals as their foreign revenues translate into a greater number of dollars. Next, let's consider commodities. The vast majority of globally traded commodities like oil, gold, and key agricultural products are denominated and priced in US dollars. When the dollar strengthens, it effectively requires fewer units of other currencies to purchase a dollar. This makes dollar-denominated commodities more expensive for international buyers using those other currencies, which can dampen demand and, in turn, push commodity prices down. Conversely, a weaker dollar makes these same commodities cheaper for international buyers, which typically stimulates demand and generally leads to higher commodity prices. This inverse relationship, according to our research, is particularly potent with gold, which often serves as an alternative store of value to the dollar itself. Then we have the critical impact on international investments. For US investors holding foreign assets, a strong dollar can unfortunately erode returns when those assets are eventually converted back into US dollars. A weak dollar, conversely, can actually enhance those returns. For foreign investors looking at US assets, a strong dollar makes US assets more expensive to acquire initially, but it also increases the value of their US dollar-denominated returns once repatriated. Fourth, and this is crucial, the DXY's influence on interest rates and monetary policy. The DXY very often acts as a forward-looking indicator reflecting market expectations about US monetary policy, especially interest rate decisions by the Federal Reserve. When US interest rates are rising or there's a strong expectation of hikes, it tends to make dollar-denominated assets more attractive. This draws in foreign capital, which in turn strengthens the dollar and pushes the DXY higher. Conversely, falling interest rates can make the dollar less attractive, leading to capital outflows and predictably a weaker dollar. And finally, its role in inflationary and deflationary pressures. A strong dollar can have significant disinflationary effects here in the US by making imports cheaper. On the other hand, a weak dollar can contribute to inflationary pressures by making those same imports more expensive. It's a direct pass-through effect. So, for investors like us, how do you practically incorporate this powerful insight into your strategy? Based on our continuous observation, here are 5 key approaches. First, monitor Federal Reserve policy religiously. Keep a very close eye on every announcement from the Federal Reserve, every interest rate decision, and their economic projections. These are fundamentally the primary drivers of the DXY. Second, analyze corporate earnings transcripts with a keen eye. When you're reviewing earnings reports, pay particular attention to what management teams say about foreign exchange impacts on their revenues and profits. Companies with substantial international exposure will almost always highlight this, and it gives you a direct read on how currency shifts are affecting their bottom line. Third, diversify your portfolio intelligently. It's crucial to understand that a strong or weak dollar will have distinctly different effects on various sectors and asset classes. Diversification, in our view, is your best defense against the inherent risks associated with currency fluctuations. Fourth, strategically consider your commodity exposure. If, through your analysis, you anticipate a weak dollar trend, increasing your exposure to dollar-denominated commodities might be a very strategic move. Conversely, during periods of dollar strength, commodity investments could very well face significant headwinds. And fifth, use the DXY as a powerful confirmation tool. The DXY can act as an incredibly valuable confirmation indicator for your other analyses. If your technical or fundamental research points to a certain market direction, cross-referencing that with the DXY can provide significant additional conviction. For example, if you believe inflation is on the rise and commodities are set to benefit, a weakening DXY would strongly support that very thesis. What we've observed in recent years is significant volatility in the DXY, largely driven by ongoing global economic uncertainties, persistent inflation concerns, and the differing paces of monetary policy tightening across major central banks. For instance, during periods of heightened global risk aversion, such as economic crises or geopolitical tensions, the US dollar very often acts as a safe haven currency. This typically causes the DXY to strengthen dramatically as investors flock to perceived safety and liquidity. Similarly, when the Fed embarks on an aggressive rate hiking cycle, the DXY consistently tends to rise, attracting capital seeking higher yields. In my view, understanding the DXY isn't about perfectly predicting its exact day-to-day movements, it's about recognizing its broad trends and grasping their wide-ranging implications. By consciously incorporating this powerful indicator into your research framework, you will gain a much more holistic view of the market landscape and be far better equipped to make truly informed and strategic investment decisions. What key takeaways are you drawing from the DXY given today's market environment? The last thing I wanted to share on this DXY topic is this snapshot from my Excel showing the impact of the DXY on each specific sector. If you find my analysis interesting, subscribe and be honest, give a like or dislike depending on what you think.